Good afternoon and welcome to our first online conference in lieu of our client briefings during this crazy time period of a pandemic. You're very welcome. Today we want to give words of reassurance. We want to thank you for the confidence you've placed in our AP Wealth Management team. We're grateful and we understand that responsibility. You're currently being muted. Please ask questions in the chat box. It'll be down to your right. Sharon is monitoring that. And if you'll reply directly to Sharon rather than everyone, she can get those questions and forward them to me. I will either address the questions if it's pertinent to what we're talking about, or we will have as long as we need for a question and answer session when we're done. I'm here as long as I need to answer your questions. We know you have a lot of them and you're looking for confidence in leadership, and we hope this is a first step in that direction today. Can everyone hear and see us okay? If you can't, please make a comment in the chat box down to the right that I referenced earlier, and we'll try to rectify that and get you some help. This is our first attempt at video conferencing, and we hope to do more. Please be patient as we migrate through this new capability. We, as always, welcome your feedback and your suggestions on how we can improve and get better. We're also recording this so that if you want a copy, we can send you a copy for clarification and reinforcement. But also, if you know someone who might need some reassurance and some confidence, we're happy to share it with them or allow you to do so. There's a lot of information out there. And as always with our briefings, we're just trying to give you information that's meaningful and useful to you that will allow you to make good decisions moving forward. Just a thought that I've had is forget about the events that are going around us right now. Don't put them completely out of your mind, but focus on your responses. We can't control what's happening. We can only control our reaction to what's happening. And with that, we'll get going on a couple of slides here. So, just some observations about what's going on. The financial markets loathe uncertainty. And this is certainly one of the most uncertain times we've had financially and as a community in my lifetime, and maybe in many of yours. When will the coronavirus be contained? How will it affect global economies? When uncertainty surrounds our world, the financial markets head for the safest places they know, which right now is cash. This is also likely to be a self-fulfilling prophecy. Everyone has to reduce their interactions and stop buying everything from restaurant meals to perhaps maid service, anything that would allow interaction. We've got to stop. There are likely to be layoffs, loan defaults, and consumption of all types is going to decrease and result in a reduction in consumer demand. Regrettably, consumer demand is about 70% of our gross domestic product or our economy. So we're going to see some effects of this moving forward as we practice social distancing and we sequester ourselves in our homes. But it won't last forever. So that's a good segue into one of the first things that we want to talk about in a suggestion. Quit looking. Quit looking at the news, quit looking at the markets. We don't mean to bury your head in the sand. Be informed. Know what's going on. Look on some sort of regular schedule, whether it's weekly for you or every other day or once a month. But good decisions are not going to come from looking at the news or financial markets 3 to 4 times a day. They're not going to change what you do, and they're certainly not going to change what you're thinking for the better. We know that we will get through this. We know that at some point things will change. We need to trust history and countless studies about the financial markets, and don't give in to fear. You've made good decisions so far. I know there are clients and non-clients on this broadcast, but we've helped you make good decisions. We haven't made those decisions for you. Your time horizon and your risk tolerance, which we're going to talk about in a little bit, have not changed. Trust your past decisions and the portfolio allocation and the discussions that we've had and you've thought about when we were not in panic mode. Remember, you're in the right place. This time is not different. Certainly the circumstances are different, but Black Monday, the dot-com bubble, the bust afterwards, 08 and 09, we've seen these before and we have recovered. We haven't seen a coronavirus, but as I mentioned earlier, the markets hate uncertainty, and uncertainty is what surrounded many of these past downturns. And also remember, you're not alone. Everybody's experienced this. Misery loves company. It doesn't make it better, but you're not alone. This next slide shows $1 million portfolio in which it had a 60-40 allocation, 60% to stocks and 40% to bonds. And that's reflected in the far left bar, and the date is 2/20/20, or February 20th of this year, before we had the market downturn that we're experiencing. So what we did is we took that $1 million and we said, all right, on the 16th of March, what had happened to that $1 million? So in the dark blue, the bonds had decreased to $395,294, and the stocks had decreased to $437,500, or about 27%. We assumed in this sample portfolio that the person who owned this needed $80,000 a year, or 8% of the original $1 million. So they had to have that money. What does that mean to them? Well, in year 1, year 2, year 3, year 4, and year 5, moving from left to right, we have assumed that this person has taken out $80,000 a year. And what you will notice is that's being taken from the bond portion, because the bond portion decreases going from left to right, and the stocks have not been touched. The point of this is you or this person does not have to sell stocks at a low point. We want to give them time to recover, which we know at some point they will. We just don't know when. But for 5+ years, this person who's taking a large amount out, $80,000 or 8% on $1 million portfolio, never has to sell stocks to get that money out. A couple of clarifications here. We're growing the stock portfolio at 8%, and we're growing the bond portfolio at 2.5%. Likely, this is a worst case scenario, because we think there'll be a much bigger bounce back than 8% on a stock portfolio over the next 5 years. We don't know, and we don't know when, but history tells us stocks will deliver an 8% plus return. The other thing that's worth mentioning here is this particular person could say, you know, my plan was to take $80,000 out, and I don't really need $80,000 in these difficult times. I'm only going to take $60,000 out, and I'm going to tighten my belt buckle a little bit. Well, these numbers would be even better. Also, as you know, we would rebalance this, buying stocks when they're at a lower price and selling off bonds when they're at a higher price. So we would adjust the target allocation moving forward so that likely stocks would be a higher portion of this portfolio. Again, we're given a worst case scenario here. The point of this is stocks do not need to be sold in order to generate most folks' living expenses, if at all. And if you take in year 5, 104 and 595, I'm just doing the math very quickly, that's about $700,000. Well, you started out with $1 million, you took out 8 times 5, 400,000, and you've still got 700,000 in a worst case scenario. The point of this is don't panic. There's hope. You're not forced to sell stocks. In this next slide, this is the Jones Industrial Average from 1896 to 2016. And it just shows there's lots of ebbs and flows in the markets over time. Don't worry about all the data here. Each point numbered 1 through 121 details a particular current event at that time that may have affected the up and down of the market. But the markets do recover and they do grow moving forward. The most important thing on here, and what attracted me to this slide, was the upper green part right up at the top. Human innovation always trumps fear. Well, we will react to this virus and the things that it has caused, i.e. the markets dropping, and we'll find a shot that will help us, and we will get over this. A vaccine, we will get over this because human innovation always trumps fear, and we're fearful right now, and we understand that. This is called the Dow Study, and it is very good. It's data from 1996 to 2015. So I'm going to just give a description moving from left to right. So over that 20-year period, if you'd invested in US stocks only, your return would have been 8.19%. Moving to the right, if you had invested in US bonds over that time period, you'd have made 5.34%. International stocks delivered a return of 4.83%. Homes increased in value by 3.14% annually. Inflation, or the cost of goods and services rising over that time, was 2.2%. But the far right, the average investor, despite all that during that time period, made 2.11%. This is behavioral finance, when our gut screams, sell as prices plummet and buy as prices rise. We need to do the opposite. That 2.11% is because of our loss aversion instinct. We sell when we panic and we buy when we feel good. The opposite is true. And it starts with having confidence in your portfolio, which starts with being in the right place for you. That right place is based on your time horizon and your risk tolerance, which we'll talk about here in a second. But as you can see, if you had just stayed in US stocks, 8.19% is what you returned over that 20-year period, or almost 4 times what the average investor did. We can't give in to fear and panic. We have to put our emotions aside. That's part of our job to help you. This also begs the question is, why don't people just invest completely in stocks? Well, as you get older and move closer to retirement, your time horizon and risk tolerance decrease, so you don't want to have that exposure, because as we looked at previously, there are times when the market ebbs and flows, so we want an asset allocation that makes sense. This shows the risk of stock market loss over time from 1926 to 2019. Really, it should be titled Time is Our Friend. So the first graph at the very top, the blue indicates up markets or positive returns in the stock market, and the purple, or the downside, shows losses by 1-year increments. So over that time period, 73% of the time to the right, there was an up market, and 27% of the time there was a loss by year, in 1-year increments. So the next one down shows 5-year increments. And you can see during the Great Depression over to the left where there's some purple, and various other times, including 08 and 09, when you look at stock returns over a 5-year time period, 13% of the time you lost money over a 5-year time period, and 87% of the time you made money in 5-year increments in a stock portfolio. Taking it one step further, when we break that down to 15-year time periods, the math gets easy here. When we look at 15-year time periods over the last 100 years, 100% of the time, the market returns were positive. Time is our friend. We don't need to react. You'll likely recognize this slide. This is one that's a staple for us. As you know, we are asset allocators first. So if you see the triangle, the upside down or inverted triangle to the right, asset allocation is what determines over 92% of variance in portfolio performance. It's not timing the market. It's not picking the right stocks. Those are all down at the bottom. It is being in the right place for you at your time in life. And that's based on your risk tolerance, how you feel in your gut and in your soul and in your head about the market, and time horizon. When do you need this money? That's the cornerstone long term. Then this one is also a cornerstone of our practice. To the left, total return is equal to income plus capital appreciation. So we know what income is going to be from various investments that we use: capital gains, dividends, interest income. We can control that. The capital appreciation part, we cannot. We don't focus on that, but if we focus on it over the long term, we know that capital appreciation in stocks will be positive. I'll reference the 15-year and mostly 5-year time periods that I showed you earlier. To the right is the efficient frontier. So that graph you see is on the left axis is return and on the bottom axis is risk. So someone who's older and wants to protect, they're going to be on that closest one to low down in the left-hand corner, where they're willing to accept a lower rate of return, but they don't want to take a lot of risk. Up to the right, as you follow that curve, someone who's young, they want a high rate of return, but they're also willing to take a high risk because they have time. Time is on their side. So I'm going to use my drawer here. If someone was in this section, they're not expecting a high rate of return, but they're taking too much risk. That doesn't make sense. So we want to move them on the efficient frontier up here so that their return is higher for the amount of risk that they're taking. So the whole idea here is, when we construct the portfolios, to make sure that we're on somewhere on this efficient frontier, again, based on your risk tolerance and time horizon. Then many of you are aware, we categorize our investments into 4 groups: attain, relative return, opportunistic, and protect. Opportunistic is really of particular importance and in the vanguard for us right now, because when prices are down like they are now, we think there's probably opportunity. You will see us wait until we see some stability, but once we see some stability, we are apt to begin making some decisions on where we're going to invest and how. We do think there's opportunity, again, long term. We've gotten a few questions, so I'll walk through those. The first question is, it's quite common, and I understand, to hold on and wait for a rebound, and that's part of the approach. Is there any logic to selling and then repurchasing on the early side of the rebound? It's a great question, and it assumes that we know when the early side of the rebound will be. We don't know that. We didn't know, we certainly didn't know that we'd have a downturn like this. We suspected, when we had the great returns we had in 2019, that at some point the market had to come back down to earth. We didn't think it would be this fast and this quick. And that's a great point to note. We've seen downturns of this magnitude before, but we have not seen downturns that are this speedy, that have happened this quickly. And that's probably what's alarming people more than anything. So again, it's a good question, but you have to be right twice. You have to be right when you get out, and you have to be right when you get in. And we don't know. We could have thought a week or two ago that the market would have turned around, and it's dropped by another 5 to 10%. The next question is, based on the current market conditions, is AP Wealth Management considering a more conservative or defensive approach going forward? Another great question. It reflects back on what I said earlier about if you're in the right place for your risk tolerance and time horizon, and if you're a client of AP Wealth Management, you know that we talk about that on a regular basis with you, and we're always having you complete questionnaires and other ways determining that you're in the right place. Then no, we don't want to get defensive, because trying to time the market or locking in these losses doesn't make sense. And I'll harken back to that first slide I showed you. If you need cash, and we knew you were going to need cash, then we've probably got you in some cash and some bonds that should last for quite a while we give this stock market time to recover. Next question is, will there be any opportunities for refinancing mortgages? Yes, absolutely there will be. Interest rates have already come down. You should look at that. That's certainly part of an overall plan and not just an investment decision. But we know that recently we saw a 15-year 2.57% fixed mortgage. Again, that's a different question for everybody because everybody's unique, but it's certainly worth investigating any debt that you have. Is there any reason to invest in precious metals? Another great question. Typically, gold is a haven for inflation or in times of downturn. Gold has done better, but yesterday's a great example. The markets went south, gold went south as well. So we're not big fans of gold. They're very, in precious metals, gold has very other utility use besides being a hedge against inflation. And yesterday was a great example. It went south when the stock market went south. Another good question, is the market still forward-looking, or in this environment has it become day-to-day functioning? The market is certainly forward-looking because of what we mentioned earlier. The financial markets are uncertain about how long the coronavirus will last, what effect it will have on our economy, and it's moving to cash to try and conserve capital, because a known return of basically zero right now in cash is better than an unknown return in equities. So it's absolutely still forward-looking, and some might say it's too forward-looking because perhaps this virus will extinguish itself faster than many people think. We hope you've enjoyed this. It's our attempt to communicate with you and provide some leadership and provide some confidence in these times where we all need confidence. Let's support each other. We're here for you. What we need to do is be disciplined like you and be there for you. What we fear the most is the unknown. This is not unknown. Certainly the circumstances are unknown, but the outcome ultimately will be the same as 1987 Black Monday, the dot-com bust of 2001, the Great Recession of 08 and 09, and a host of others. There will be opportunities here. We need to keep that in our mind and see that we keep our calm and move forward. Again, thank you for the confidence that you placed in us. We're on call at any time to answer any of your questions and provide guidance. Stay safe and wash your hands. Thank you.